Dividend growth investors, bonjour. This is Mike Giroux, founder of Dividend Stocks and passionate investor. I'm here on this YouTube channel to help you invest with conviction so you can enjoy your retirement. Speaking of which, today we're doing an overview of a very popular sector for retirees, and it is utilities. By my accent, you probably catch that I am French Canadian and my mother tongue is not English. And the first time I heard the word utilities, I thought, oh, this sounds like utile in French, and utile in French is useful, and it is pretty much a very good definition on utilities because they provide you with power, electricity, gas, and water. So basically everything you need to live in a comfortable house, a comfortable apartment, and have access to everything that you want for your household and your family. So now, why utilities is so interesting for retirees and for your portfolio. We're going to dive into this topic and we're going to do a quick overview. At the end of this video, I will also provide you with a complete list of all utilities with a bunch of metrics to help you dig in a little bit further and select the one that will fit in your portfolio. So first, let's start with the 5 different types of utilities because it's not that simple. There's a lot of subsectors. So the first one that we were going to discuss is renewables. Renewable energy, kind of confusing because a lot of people would thought, well, this should be part of the energy sector, but the energy sector is really about oil and gas, while renewable energies like wind, solar, and hydroelectricity are part of utilities. This is a thriving subsectors. There's a lot of money being invested into green energy these days. A good example of a great company could be Algonquin, which is a Canadian company but paying their dividend in US dollars. So quite interesting if you're Canadian but you want to spend a few months in Florida during winter time. So basically, they are heavily invested into wind and solar energy, and this is probably like the way of the future. You will also find companies that are digging a little bit on everything. We call them diversified utilities. A good example would be Brookfield Infrastructure, which they have pipeline, storage, transmission, electricity customers. They even operate ports and railroads. So they're pretty much all over the place. And they will either provide gas or electricity by different means. So this is why we call them diversified. They are very stable. They usually they deserve a lot of geographic sectors, and they're quite active. And then you have utilities that decide to be a little bit more targeted and evolve in a specific niche. So you have electric utilities. A good example would be Duke with over 7 million clients operating in Kentucky, Florida, Ohio, and other states. And then you have companies evolving in natural gas like Atmos, which is the largest pure play into distribution, storage, and pipelines for natural gas. They operate into 8 states. Most of their business is coming from Texas. And finally, you have regulated waters like American Water Works. The water utilities are quite popular because they have lots of growth possibilities for the upcoming years, especially because water connection needs major upgrades. And whenever you can invest into upgrades into safety, then you can ask for tariff rates for your customers and you can make more money. So it's a great place to be for water utilities such as American Water Works. Speaking of the difference between regulated and deregulated utilities, you will often find those two terms when you do dive into the company description. So I wanted to make the difference between those two terms because it's very important. So when you're talking about regulated utilities, we're talking about a company that is fully integrated. So we call it vertically integrated. This means that the energy is generated by the company, the mean of transportation, the distribution. So they basically go from producing the energy all the way down to serving customers. It is the same company. They enjoy a monopoly where a customer doesn't really have a choice. And you can think of a lot of electricity utilities works like that, mostly because it's more efficient way for states or provinces to provide electricity through one single company that will manage the entire network. On the other side, what happened is you cannot leave a private company in a monopoly stage doing whatever they want whenever they want, right? So on the other side of the equation, you will find regulators. So basically the way it works is when you have a regulated business, you're going to invest in your new project, so to improve your power grid or to improve safety or water connection, for example. And then you're going to come to the regulator saying, hey, listen, I invested $3 billion over the past 2 years. Now it's time for me to get my money back. So I would like to increase my rates by, I don't know, 8%. And then the regulator will study the demand and then we'll try to find a fair price point between what the customer can pay and how the company can be profitable at that rate. So this is the one type, and there's a one type of contract. So you basically, as a customer, you deal business for your electricity with Duke. Well, you pay X amount per consumption, and there you go. It is being regulated. So the advantage for those companies is they are evolving in a stable market because it's a monopoly. If the states or province is on a thriving economy, well, they will likely make more money because there will be a higher demand for power or for water. And finally, you also have to look at how regulators are either favorable for the companies or for the consumer. So depending on the states, you will find more shareholder friendly regulators than others. Now moving on to deregulated companies, where competitors can buy and sell electricity and play the retailer for power. So therefore, the customers have the choice. They can compare, they can have different types of contracts. So it could be like fixed or variable for like 2 years or 5 years. So there are like a lot more competition involved and customers can hope for better rates, and most of the time it's a little bit riskier for the business at the same time because they cannot just sit there and enjoy their monopoly. They have to compete against other retailers. So this is where it gets interesting for the customer, but not necessarily always for the shareholders. There are also more availability for renewable resources on this point. There's a lot of companies that will rather focus on developing and producing the electricity and then sell it to retailers instead of holding the whole thing, because it requires more knowledge and investment in technology into producing wind or solar power. So they rather concentrate on that and then sell the electricity to retailers. So this is where you're going to find a little bit more of competition. So which is very good for customers, not necessarily a good thing for shareholders at the same time. So it is just important to understand the difference between the two and to understand that if you're about to invest in a deregulated utilities, earnings and revenues are likely going to be a little bit more volatile than the ones that are regulated. So now, why should you have utilities in your portfolio? I'll be honest, they're quite boring, and it's a good thing. It's a very good thing if you're looking to include some stability in your portfolio and you want to have a decent yield. Those businesses are stable. They're easy to predict in terms of cash flow and in projects because they will tell you in advance. So most of the time when you dig into quarterly earnings or investors presentation, you will have also their capital expenditures, so their CapEx projects. They will tell you they will invest like $2 billion per year for the next 5 years, and they expect to increase their earnings by the same amount, like let's say by 6% per year. And then you'll have the dividend growth policy that will be attached to it, which is kind of like reassuring. So especially during like times of market volatility, utilities will pretty much give you what they tell you that they would give, and you can sleep well on that. Depending on the stock, you can have some decent yield because most of utilities will target a 50-60% distribution rate. So safe yield, generous yield for some others in the water industry, as they're very popular right now. The yield is not impressive, but you'll get it will come with some dividend growth, which is really good. When you analyze those businesses, it works very well if you use the dividend discount model, because there's a lot of value put into the dividend payment potential. You're basically buying something that will not go away, and regardless of what's happening, if there's a recession or a pandemic or whatever, like change of president, well, you know what? People will need to drink water, they will need to eat their home, and they will need to have electricity, right? We cannot live without electricity, and this is why it will be so easy for those businesses to go through the recession, just manage their budget easily, and that will work out well. Right now we are a little bit late in the party. It's been 10 years, interest rates are super low, which means that those businesses are capital intensive. They need lots of debts to finance their project, and because interest rates are very low, it's very easy for them to put a lot of money on the table and then grow and then invest in safety and water connection and so on, and then go back to the regulators and say, hey, you know what, we've been spending a lot of money on our power grids and so on, so now we'd like to increase our rates, and it's usually accepted. So all of this to say that the market, I've seen it, you'll see that lots of utilities now looks a little bit overpriced, but you pay for quality, you pay for stability, so it's something that you need to take into consideration. There's obviously a lot of upside potential for renewable energy, but there's a lot of hype around it as well. So lots of companies are betting on the fact that government will continue to spend a lot of subsidies to boost solar and wind energy development. It is going to happen, but the market knows already, so the easy money is gone for that part, but yet you're still buying something that is very solid. Now, unfortunately, there's also some downsides of investing in utilities. As I mentioned earlier, those are capital-intensive businesses. This means that they require billions of dollars each year to maintain and make sure that their infrastructure is on pace with customers' growth and demand. So this means that right now it's a good time for them to invest because debt is cheap, but it doesn't mean that debt will always be cheap in the future. So at one point in time, if interest rate rises, it's going to be very difficult for those companies to pay their debts and to weight that burden. So when you look at utilities, make sure that you take a small detour, look at their long-term debts and see how it has been paid and how cash flow is being generated to make sure that they can afford this kind of debt, even if interest rate rises and they have to renegotiate some of them at a later time. There's not always growth, especially during a recession. You can expect demand for power, notably, that will go down. Some companies are closing they're closing. Some industrials are slowing down their pace. So the demand for energy and power will be a little bit less in 2021. This will hurt their earnings, but at the same time, they will still continue to invest in their power grids or water connection. So this means that don't expect something that is just like crazy in terms of results for the next 12 months. At the same time, prices are still remain high because this is a safe haven for your money, and this is probably the point where it's hard to invest in those. It's because a lot of retirees, because of interest rates are super low, they cannot find bonds or GICs that make sense for them, so they move their money towards REITs or utilities in the hope of getting a better yield. So more demand on the stock price increase, the yield goes down, so it's not the end of the world, but it's not like the best investment ever at the same time. So my advice to you, if you want to take it, is if you invest in utilities, don't expect too much. Look at them as the Luke's bond. They will do what they have to do, so provide stability in your portfolio and reward you with some good yield. And this, I think, is the most important part, right? in the upcoming weeks, what I'm going to do is I'm going to share with you my favorite utilities. So we're going to have the videos on renewable energies, another one on American utilities, and the last one about Canadian utilities. So I'm going to do a 3-part series on that, telling you about my favorite companies and how I think they should thrive in the future. And in the meantime, you can go in the link description below. I've used DSR resources to pull out the list of all utilities being traded in Canadian or US soil, where you have revenue growth, earning growth, dividend growth, payout ratios, and so on. So it will help you to do some filters, do some research in the meantime before I can publish those videos. And I hope that it will help you a little bit in your portfolio building. So until the next video that will be about renewable energy, stay invested. Cheers.